The following production is presented by League Info Site and the Credit Union Broadcast Experience, QTV.
Hello, I'm Gloria Ledoux.
And I'm Sean Wolbert, bringing you the quarterly compliance update at the CU Compliance Connection by InfoSite, only on QTV.
This presentation will provide information on the compliance issues your credit union has worked on in the fourth quarter of 2013 and the issues it will face in the first quarter of 2014.
Glory, 2013 was a whirlwind year. Leagues and credit unions across the country worked to understand and begin to implement the CFPB's mortgage rules, which took effect in January. Today, we're going to look at the things that happened in the fourth quarter of 2013. And those issues include the CFPB International Remittance Transfer Rule, which is obviously not one of my favorites. And you've heard that before in other issues that we've done of the CU Compliance Connection. We're going to talk about the CFPB's Credit Access Rule, the NCUA Liquidity and Contingency Funding Plans, the NCUA's Electronic Filing Requirements, and Charitable Donation Accounts, the FFIEC's Social Media Guidance as well.
And we're also going to go over the CFPB mortgage rules, which took effect in January. And it feels like we've been talking about these for quite a long time in these compliance videos as well. But we're going to start with the ability to repay and the qualified mortgage rule. We're going to talk about the loan originator compensation rule, valuations and appraisal requirements, HOEPA rules, or the high cost mortgage rules, and mortgage servicing.
And we're all struggling to implement all of these right now. I know that the credit unions are really having a hard time dealing with everything that they're learning to understand currently.
Right.
So with the CFPB International Remittance Transfer Rules, the International Remittance Transfer Rule went into effect in October of 2013. And although this requirement got a lot of press and flack from the financial services community, there has been little discussion since the rule took effect. The final revisions made it a little easier for credit unions to comprehend and to implement. Mm-hmm. And some of those changes were the 100 International Remittance Transfer Exemption, yep, which really took a lot of the small providers out of the requirements, which made it a lot easier, yes, for the credit union industry. Yep. It also reduced the liability if the member provided the incorrect information. And this was the hugest stumbling block as we went near to October in implementing this, was the fact that if the member gave us absolutely incorrect information, it was still, the credit union was liable for the transaction, which was not fair. No. So that has been amended and revised. Yep. There's also a temporary provision that the credit unions can provide estimates if they cannot get the correct information. Now that's temporary, it's only going to be a year or so. Right. But at least it gives them an opportunity to learn how to do the different disclosures that have to be provided to the members with information that they just don't have the ability to get yet.
Right.
We've come a long way in a relatively short time with this rule, from the initial outcry from both banks and credit unions that they would not be able to comply with the rule and would discontinue providing this, yep, service to their members.
And I think a lot of times too, Sean, with the CFPB mortgage rules coming into effect, international remittance transfers just took a back seat because there were so many more requirements to comply with the mortgage rules. So
that could very well be.
So now we're going to talk about the CFPB Credit Access Rule. On November 4th, credit unions were required to comply with the CFPB's amendments to Regulation Z, which removed the requirement that credit unions consider the consumer's independent ability to pay for credit card applicants who are 21 or older. The credit union can now consider income and assets that a consumer has a reasonable expectation of access and consider that member's general ability to repay. Although credit unions have the ability to consider assets the member has a reasonable expectation of access to, they are not required to do that. However, the CFPB does expect card issuers to give careful consideration as to how that discretion is used and the potential effect of their decision on a protected class.
And now we're going to look at the NCUA's liquidity and contingency funding plans. This has been an issue that really has been difficult for boards of directors and executives of credit unions to understand because they feel they've been operating safely and soundly for a long period of time. Right. Even through the financial crisis, not many credit unions failed due to, their decision-making process for liquidity and contingency funding. Right. And credit unions really do have a long history of planning and acting in a very careful and safe way because they really are out to protect their members' assets and their members' interests. So some of the requirements with this, federally insured credit unions, which is what this rule actually affects, with assets less than $50 million, must maintain basic written policies for managing liquidity and a list of contingent liquidity sources. So that's not very hard. For federal credit unions with assets over $50 million, they must have a contingency funding plan that sets out strategies for liquidity shortfalls in emergency situations. And for federal credit unions, federally insured credit unions with assets of $250 million or more, not only do they have to have the policies and the plans in place, but they must have access to a backup federal liquidity source for emergency situations, which means they have to either become a regular member of the Central Liquidity Facility or they have to establish a relationship with the federal discount window.
Now let's talk about the NCUA electronic filing requirement. And this was established at the October 24th board meeting by the NCUA, and they approved a rule to require all federally insured credit unions to file quarterly call reports and profile data electronically using NCUA's information management system or other electronic means specified by the NCUA. Paper filing is no longer permitted, and the NCUA will no longer mail out paper call report and profile forms. This rule was effective for credit unions on January 1st, 2014.
I really don't think this is much of a hurdle for credit unions either because the BSA requirement for electronic filing happened before this.
Right.
So they have to have a means to file electronically for BSA, therefore they should be able to file electronically for the NCUA call report.
I agree. Now let's talk about NCUA charitable donation accounts. Effective on December 19th, 2013, the NCUA rules were amended to clarify that federal credit unions are authorized to create and fund charitable donation accounts, which may contain investments that are otherwise deemed impermissible under the Act. So federal credit unions who wish to maintain these charitable donation accounts will need to satisfy several conditions. A few of those conditions include the book value of investments in the charitable donation account in aggregate is limited to 5% of the federal credit union's net worth. So federal credit unions will be required to distribute 51% of the account's total return on assets to one or more qualified charities at least every 5 years. And there's some other requirements as well. So we encourage the viewers to go ahead and review that rule in detail if your credit union plans on establishing a charitable donation account.
So our next topic is really the FFIEC's social media guidance. And the interesting part about this guidance was that they didn't give us any guidance. They said there are no new rules.
Right.
What's important about understanding this and what the credit union really needs to take to heart is that although there are no new rules, you have to follow all of the rules that we already have in place in regards to social media. And that's where there really is a disconnect because credit unions are offering things on Facebook. They have LinkedIn pages where they put promotions on their loans. They're doing Twitter accounts where they're sending out information to members. And those are advertisements.
That's right.
Even a credit union's newsletter that was so often considered not an advertisement, and even under the law is not considered an advertisement. When the credit union posts that on their publicly viewed website, anything in that newsletter is also considered an advertisement.
Right.
So it's really important for the credit union to understand that what you're doing as far as your social media, what you're doing as far as reaching out to your members through social media, you have to ensure that you take into account the regulations that govern messages and advertisements in about those types of media that you're reaching out, if it's an advertisement or a message to a member.
And credit unions also need to understand that some of the avenues that they're using, like Facebook, for example, they also have their own set of rules. So credit unions are encouraged to not only follow the regulations governing advertising requirements, but they should also look on the Facebook advertising rules because they also have additional requirements.
That's right. Now that we have covered the compliance issues that credit unions have worked to implement, we need to address upcoming compliance challenges that credit unions have to manage in the first quarter of 2014.
One of the things we wanted to talk about was indirect auto lending. For those credit unions that allow dealer markups in the indirect lending program, we wanted to make sure you were aware of the details of a consent order to Ally Financial and Ally Bank. Like many credit unions, dealers submitted applications to Ally on behalf of their customers, and Ally would provide the dealer with a buy rate, which was the minimum rate that Ally would finance or purchase the retail installment contract from the dealer. The dealer could then add a discretionary markup. Ally compensated dealers from the increased interest revenue derived from that dealer markup. After analyzing a sample of Ally's retail installment contracts, the CFPB and the DOJ determined that African American, Hispanic, and Asian Pacific Islander borrowers were charged more than similarly situated non-Hispanic whites. Ally was ordered to pay $98 million. The CFPB Director Cordray said, "The fact that Ally didn't consciously intend to discriminate makes no practical difference. The outcome and the harm to the consumer is the same." So credit unions who allow dealer markups should review the CFPB's bulletin issued in March 2013. This is very serious, and we really encourage credit unions to review that bulletin or discontinue the dealer markups.
Yeah, I agree.
Okay. Let's talk first about the ability to repay qualified mortgage rule, sometimes referred to as the Big Kahuna. Well, I refer to it as that. Remember, this rule covers your closed-end loans secured by a dwelling, first or second lien, and not limited to primary residence. So first and foremost, the ATR rule requires that you are making a reasonable, good faith determination that your member has the ability to repay the loan. These are the 8 factors to comply with. You will need to check your policies and procedures to ensure they reflect that you are considering these 8 underwriting factors. You should also be documenting how you are considering these factors. You could also consider more factors if you want. These are just the minimum, and all credit unions need to comply with these requirements. So we've listed them for you, the 8 underwriting requirements credit unions all have to comply with. So after credit unions have complied with the 8 underwriting factors, the credit union can determine if the mortgage they are underwriting will be considered a qualified mortgage, which provides the credit union with a presumption of compliance with those ATR requirements or a safe harbor. There are 4 types of qualified mortgages. Keep in mind that there are various terms and conditions that the credit union must comply with to meet these QM standards. We're just going to talk about them generally here, but credit unions are encouraged to review the Small Entity Compliance Guide or review the regulation to get all the details of each qualified mortgage category. Okay, we'll start first with the general QM category. It has the debt to income requirement of no more than 43%. So loans that have a debt to income ratio above this percentage will not be considered a qualified mortgage under this category. For a loan to be a QM under the temporary QM category, it must be eligible for purchase or guarantee by a GSE, Fannie or Freddie, which can be established by a valid recommendation from a GSE automated underwriting system. So those are the 2 general QM categories, general and temporary QM categories for all credit unions of all sizes. If you're a small creditor, which is assets below $2 billion at the end of last calendar year, and together with your affiliates, originated no more than 500 first lien closed-end covered transactions in the preceding calendar year, then you are eligible for 2 additional qualified mortgage categories. The small creditor QM requires you not to exceed certain points and fees thresholds and to consider the debt to income ratio or residual income, but there is no specific threshold. So no 43% requirement for this small QM category. Lastly, there's a balloon payment QM category for small creditors, and this is until 2016. It's available for all small creditors, but after that, it's only going to be available for credit unions serving rural or underserved areas. There are again certain requirements credit unions need to comply with to obtain this QM status, but again, there is no specific debt to income requirement or threshold. So that was a very long way of saying that all credit unions have to comply with all of the 8 underwriting factors underlined under the ability to repay requirements. There are 4 qualified mortgage categories
Yep.
that credit unions can fall under depending on the type of loan that they originate. So there's always the question, should I underwrite, do I have to originate a qualified mortgage? And the answer is no. That is a business decision your credit union needs to make, but you are not, under no means, obligated to underwrite a qualified mortgage.
Yep. And what's the risk? Well, the risk if you don't comply with qualified mortgage rules is simply that in the future, your members can say, I didn't have the ability to repay this mortgage, you never should have made it to me.
That's right.
And they can sue the credit union.
Right.
So there's actual liability risk, and that's the risk with this rule, is that the members will come back in the future and say, I couldn't, pay this mortgage back, you didn't realize that, and I want money damages.
Right. And under the rule, the qualified mortgages have that safe harbor.
Correct.
Not to say that the credit union could not defend that
Their-
they made a
their
good
underwriting
faith-
decision.
Yep, their underwriting decision, but again, the qualified mortgage gives them that safe harbor.
Yep. From the ability to repay, we're going to move into mortgage loan originator compensation. In the credit union industry, most mortgage loan originators do not receive commission compensation. And the CFPB's loan originator compensation rules don't ban this type of compensation for employees. However, they highly restrict the practice. The MLO cannot receive compensation on any of the mortgage loan's terms or conditions. They also can't receive dual compensation. So if the MLO receives compensation from the borrower in connection with the mortgage loan, he or she can't receive compensation from the credit union or another person for that same transaction. Additionally, the rule makes slight changes to the SAFE Act requirement for MLOs who want to be registered according to the SAFE Act. Now, these small changes are really a catch-22 because I don't think many credit unions realize these requirements. But the MLOs and the credit union, and I can't state that enough, it's not just the MLO's information we need now, it's the MLO and the credit union must include their name and NMLS ID on the following loan documentation: the credit application, the note or loan contract, and the security instrument. Generally, you should be including that information on all documents that require your member's signature.
That's right. And I think it's interesting, Sean, this rule really came from, you had the mortgage loan originators that were actually compensated for higher price mortgage loans. So they were steering their consumers or their customers into mortgage products that were riskier because they were compensated higher on those products. This wasn't, again, a credit union practice, but these are the rules that we have to comply with as a result of that.
Very true.
So as we move on, we're going to talk about the CFPB valuations and appraisal requirements. So the valuation and appraisal rules amended both TILA, or Truth in Lending, and ECOA, or the Equal Credit Opportunity Act. So first we'll talk about the amendments to TILA. This rule only applies to your high-priced mortgage loans. So your first lien, closed-end loans with an APR above the APOR by more than 1.5%, 2.5% for jumbo liens in first position, or 3.5% for subordinated liens. Okay, now we've established that we have a higher price mortgage loan. So what do we need to do under the new rules? Well, you're going to be required to provide a disclosure to your member within 3 days of receiving the application that they are entitled to a free copy of their appraisal. This requirement is also part of the ECOA requirements. So if you include the disclosure in this presentation, you will meet the requirements of both rules. So I would encourage you to do that for the safe harbor. For your higher price mortgage loans, you will also be required to obtain a written appraisal from a certified or licensed appraiser and provide a copy of that appraisal to the applicant no later than 3 business days before consummation. There are a few exceptions to this rule as well, so be sure to reference the Small Entity Compliance Guide or the regulation for further detail. So moving on to the ECOA rule changes, you'll notice also applies to open-end secured by a dwelling, but only applies to loans in first position. So it's a little bit different from the TILA rule. So what is consistent with the TILA rule is that credit unions are required to disclose the right of the member to receive a copy of the appraisal and/or valuations within 3 business days of receiving the member's application. Additionally, credit unions will be required to share copies of appraisals or other written valuations promptly with the applicant. So what is considered a valuation? We know what an appraisal is, so we've listed the requirements here. Keep in mind, within the regulation, there's also a significant amount of commentary of what is not considered a valuation. So credit unions will want to review that and want to make sure that they have the procedures in place to provide the disclosure requirements and provide copies of the materials that were reused to establish the cost of that home purchase to the member within the time periods required.
Yep, and a lot of times the credit unions are going to be able to give this first notice with their application documents, just like they would a lot of the other required documentation.
I agree. Make it easier for them.
Yep. All right, so we've started to talk about high-cost mortgage loans a little bit, at least some of the requirements, and now we're really going to dive into this. The high-cost mortgage and credit counseling rule makes a very significant change to the treatment of high-cost mortgages. The first part of the HOEPA rule says that not only do the HOEPA rules apply as they have in the past, but it also includes all consumer credit transactions secured by a principal dwelling, including purchase money mortgages, refinances, and closed-end home equity loans, and open-end credit plans. And the open-end credit plan, that's new. So for the first time ever, the HOEPA requirements that we have applied to other types of lending that the credit union does now apply to HELOCs. We're pointing this out because the coverage in the HELOCs is new, and we want to make sure that the credit unions understand this change.
It might be easier just to say what it doesn't apply to, because it seems to apply to pretty much everything.
It applies to everything but reverse mortgages, basically. The HOEPA rules with the high-cost mortgages require special disclosures, again, that must be provided to the members, but this time 3 days before consummation or account opening. So 3 days before you close that loan, you have to provide documentation to the member. The loan will not be effective until consummation or account opening occurs. It has to explain the consequences of default to the member. It has to disclose loan terms such as the APR, amount borrowed, and monthly payment. And if it's a variable rate, explain the maximum monthly payment that could be required by the member. So basically, it's really giving them all that information again, even though it's already required in the loan documentation. It's another disclosure to really point these risky features out to the members. The HOEPA rule bans certain loan features for high-cost mortgages, and these are for high-cost mortgages. They ban prepayment penalties. I don't think that's something in general that the credit union industry does or provides to members, so I think we're pretty safe on that. But it also bans due-on-demand features and, most upsettingly for a lot of credit unions, balloon payments. The only time that balloon payments will be allowed is if the payment schedule is adjusted to accommodate a member's seasonal or irregular income, for short-term bridge loans to finance new home purchases when the member is selling an existing home, so it's that bridge loan qualification. And then, if the credit union is serving predominantly in a rural or underserved area and meets the ability to repay in qualified mortgage rule requirements. The CFPB provides a list of rural underserved areas, and the credit union will need to use it to determine if they qualify for this exception and they want to continue to provide balloon mortgages. The HOEPA rule also contains a requirement that members receiving high-cost mortgages must have HUD counseling before closing the mortgage loan. And I'm sure this is going to go over really well with members. I can just imagine the conversation, oh, Mr. and Mrs. Smith, congratulations, we want to do your mortgage loan. Before we can do that, you need to go get counseling. And the member just sits there going, I don't need counseling. Oh, yes, obviously you do. You need counseling. Right. The conversation is not going to be fun to have with the member. The requirements of the counseling are difficult for members to comply with, and I really see this changing perhaps people's choice in whether or not they really want to receive these types of mortgages. The counseling certificate that's required for loans closing cannot be issued until the counselor so that HUD counselor,
Yep.
has verified that the member has received all of their high-cost mortgage disclosures, including their settlement statement. And the CFPB has stated that due to the requirements, counseling may need to be done in a two-stage process. The first stage giving them, the initial disclosures and talking that member through, is this the right choice for you? Is this a good choice? Is this the type of mortgage you want to do?
Right.
And then the final counseling piece, getting the additional disclosures in the settlement statement to make sure that everything meets those guidelines and requirements, and then issuing the certificate of counseling to the member so that they can give you the certificate of counseling before you close the loan.
Right.
It's going to be a mess.
It's going to be challenging for
It
everyone.
really is, especially in rural and underserved areas.
Yep.
Because the counseling's probably going to have to take place on the phone or in some kind of a
That's right.
remote way, which is going to be really hard.
And credit unions need to remember that it cannot be someone on their staff.
Good point.
Yep.
Yeah, it cannot be someone on your staff. Credit unions are going to be required to provide a list of homeownership counseling organizations to members applying for a mortgage loan within 3 business days after application. This includes first and subordinate liens on residential real property designed for 1 to 4 families. So let's go back a minute. I want to say that one more time. On your residential real estate loans, first or subordinate liens, you have to provide a list of credit counselors.
Yep.
And even that is a little tricky because you have to be able to meet the requirements of the loan. Now, there's an exclusion for reverse mortgages and mortgages secured by a timeshare. But other than that, all mortgages are going to comply.
Right.
And with the counseling requirement, they have to provide 10 counselors within an area that member's zip code of the property that they're getting the loan on actually falls.
Right.
So you're pulling the disclosure every time a member applies for a mortgage
Right.
loan.
And they say that the list has to be updated within at least 30 days, which it seems like it would have to be more often if it's going to be pertinent to that particular member's
Zip code.
zip code, but they also give that guidance as well.
Yeah.
So now let's move on to the CFPB mortgage servicing rules. There's a significant amount of requirements for credit unions to comply with related to the mortgage servicing rules. The new rules amended both RESPA and TILA. The RESPA revisions require credit unions to comply with regulation changes related to error resolution and information requests, force-placed insurance, general servicing policies, procedures, and requirements, early intervention with delinquent members, continuity of contact with delinquent members, and loss mitigation. These rules apply to closed-end consumer loans secured by a dwelling. The mortgage servicing rules also amend Regulation Z, or TILA, and make changes to the interest rate adjustment notices for adjustable rate mortgages, and established requirements for the prompt crediting of payments and responses to requests for payoff amounts, and established periodic statement requirements for closed-end mortgage loans. So credit unions that are considered a small servicer, which means that the credit union, together with their affiliates, service 5,000 or fewer mortgage loans, and the credit union or affiliate is the creditor assignee for them all. So if your credit union qualifies as a small servicer, you're exempt from certain mortgage servicing requirements. Small services are still required to comply with the ARM disclosure provisions, prompt crediting and payoff statements, and other force-placed insurance provisions, error resolution and information request provisions, and some of the loss mitigation provisions. So even though you're a small servicer, you are still going to have to comply with a certain amount of the mortgage servicing rules, just not as much as the non-small servicers. Again, we encourage credit unions to review the CFPB's small entity guide for further details on the requirements under each rule. We only have a certain amount of time, so there's a lot of things that we can talk about, but we would be here all day.
We could go for days on that one. I think one of the things that is important to point out is that when you're looking at these rules, I am still getting questions, and I know you are too, about these rules don't apply to me because the CFPB does not regulate credit unions, or the CFPB doesn't regulate smaller credit unions, so I don't have to comply with any of these rules. That is absolutely not true. As many times as I hear that phone call, I think there must be 10 other credit unions out there that think the same thing. These rules apply to all credit unions. There are some exceptions and exemptions within the rule that are built in to make it easier for smaller services. But even if you're a small servicer, there are still, in most of these rules, things that you are going to have to comply with. And the NCUA and the state regulators are going to be reviewing this because they went into effect in January.
That's right. Credit unions just need to remember that the CFPB is now designated for this rulemaking authority. So they're changing the regulations that we, as credit unions, have to comply with. So it doesn't matter that they're the ones overseeing us from a regulatory perspective.
No.
It's going to be still our state regulator or the NCUA, but they're the ones that are changing the rules that we have to comply with.
Yep.
So I want to thank you for joining Sean and I at the CU Compliance Connection, and stay tuned for future broadcasts on issues that affect your credit union that are hopefully not as long as this one.
We're here to help you at the CU Compliance Connection by InfoSight, only on Cube TV.
Thanks for watching the #1 compliance program for the credit union community. Stay tuned.